Imagine it's the summer of 1928. You're Margaret, 41 years old, the personal secretary to a very wealthy man, Charles, a second-generation textile manufacturer in Philadelphia, whose family has been in business since 1887. You have worked for Charles for 11 years. You know his schedule, his correspondence, his habits, and because managing his affairs requires it, the broad outlines of his financial life. Charles is not a flashy man. He does not own a yacht. He does not maintain a racing stable. He does not appear in the society pages with any regularity, and he does not, as far as you can tell, particularly want to. What he has is money, a great deal of it, accumulated across 2 generations of manufacturing wool fabric for the American market, and the kind of quiet, methodical attention to that money that people who have built something over decades tend to develop as a permanent condition of their personality. In the summer of 1928, you begin to notice something. Not a single dramatic thing. A collection of small things, each individually unremarkable, that in aggregate form a pattern you cannot name but can feel. Charles stops extending credit to his wholesale customers, the department stores and garment manufacturers who have been buying fabric on 30- and 60-day terms for years. He does not make an announcement about this. He simply begins requiring payment at delivery, quietly, one account at a time. He sells a parcel of commercial property in downtown Philadelphia that he has held for 12 years and has been telling his brother-in-law for 2 years that he intends to hold for 12 more. He reduces the company's inventory orders, the raw wool purchased in advance of the season, to the minimum required to fulfill confirmed orders only. He moves a significant portion of his liquid assets into treasury instruments and calls his banker in New York to ask detailed questions about the bank's exposure to stock market loans. He does not sell his business. He does not move to Switzerland. He does not do anything that would attract attention or require explanation. He simply, methodically, and without apparent urgency, stops doing several things he had been doing for years. In October 1929, the market collapses. Charles's textile business suffers. There is no version of the Great Depression that leaves a Philadelphia manufacturer untouched, but he does not go bankrupt. He does not lose the building. He does not lay off his entire workforce. He survives, contracts, and is still operating in 1935 when 3 of his principal competitors have closed permanently. Margaret watches all of this and files it away. She is not wealthy herself. She has a savings account, a small life insurance policy, and a rented apartment on Spruce Street. She loses nothing in the crash that she cannot afford to lose, partly by luck, partly because she had been watching Charles for 11 years and had, without quite articulating it to herself, absorbed something about the difference between how wealthy people behave when they are confident. The behavior Charles abandoned in the summer of 1928 is the subject of this video. This is History Meets Economics, where the past isn't past. Here is the question I want you to sit with. Do you think the behavioral signals that precede economic collapses are visible in advance, or do you believe that every collapse is genuinely a surprise to everyone, including the people who come through it best? I want your take, not the headlines. The conventional narrative about economic collapses is that nobody sees them coming. This narrative is enormously convenient for the institutions and individuals who are paid to manage risk and fail to do so. It is also examined carefully against the historical record, not entirely accurate. What is accurate is that the precise timing and specific trigger of any given collapse is genuinely difficult to predict. Nobody rang a bell on October 24th, 1929. Nobody sent a calendar invitation for September 15th, 2008, the day Lehman Brothers filed for bankruptcy. The exact moment of rupture is, in almost every documented case, a surprise, at least to the people who experience it as a rupture. But the conditions that make a rupture possible, the leverage ratios, the asset valuations disconnected from underlying earnings, the debt accumulation, the concentration of risk in institutions too interconnected to be allowed to fail, these are not invisible, they are in the data. And the class of investors who have the longest time horizons, the most direct access to that data, and the most to lose from being wrong about it have, across every major collapse of the last century, displayed a consistent set of behavioral changes in the period preceding the event. Not predictions, not dramatic exits, behavioral changes, specific things they quietly stopped doing. Here are the 5 most consistently documented. The first thing the wealthy stop doing before a collapse is extending unsecured credit to customers, to business partners, to anyone whose ability to repay depends on conditions remaining as they currently are. Credit extension is the circulatory system of a functioning economy. Businesses sell on terms, suppliers extend payment periods, banks lend against future earnings. The whole system runs on a shared assumption that tomorrow will resemble today closely enough that obligations incurred today can be met from tomorrow's revenues. When that assumption begins to feel less reliable, the first behavioral shift in sophisticated commercial operators is a quiet tightening of credit terms, not an announcement, not a policy change, simply a gradual shortening of the periods on which they are willing to wait for payment. This pattern is documented across multiple pre-collapse periods with remarkable consistency. In the months before the 1929 crash, trade credit data from the Federal Reserve shows a measurable tightening in commercial credit extension by larger, more established manufacturers, precisely the businesses whose owners had the longest experience of credit cycles and the clearest view of their customers' financial health. In the period preceding the 2008 financial crisis, interbank lending, the credit that banks extend to each other, began tightening in the summer of 2007, more than a year before the Lehman collapse, as the banks with the most sophisticated risk management began quietly reducing their exposure to counterparties whose balance sheets they no longer fully trusted. Charles's quiet shift to payment at delivery in 1928 was not a prediction of the crash. It was a response to signals already visible in his customers' payment behavior, the slightly longer periods before invoices were settled, the occasional request for extended terms from accounts that had never previously asked for them, the small but consistent deterioration in the quality of commercial credit that precedes every major contraction. He stopped extending credit because the evidence in his own receivables ledger told him the risk of doing so had increased. He did not need a macroeconomic forecast. He needed to read his own mail. The second behavior the wealthy consistently stop before a collapse is making leveraged long-term commitments, taking on debt to acquire assets whose return depends on conditions remaining favorable for years. Leverage is the mechanism by which good economic conditions translate into exceptional returns. When asset prices are rising and credit is cheap, borrowing to acquire assets amplifies gains dramatically. A businessman who borrows at 5% to buy an asset yielding 10% captures the spread on every dollar borrowed. This arithmetic works beautifully in an expanding economy. It reverses catastrophically. In a contracting one, the borrowing cost remains fixed while asset values and yields fall, and the spread that was profit becomes the mechanism of destruction. The historical record of pre-collapse behavior consistently shows sophisticated wealth holders reducing their leverage, paying down debt, declining to renew credit facilities, selling leveraged assets and holding the proceeds in liquid form in the period preceding major contractions. Before the 1929 crash, Joseph Kennedy, whose reputation for market timing in this period is well documented, had substantially reduced his equity exposure and converted significant holdings to cash in the months preceding October. Before the 2008 crisis, several major hedge funds and institutional investors had begun reducing leverage positions in mortgage-backed securities as early as 2006. When the underlying data on mortgage delinquencies first began showing deterioration, John Paulson's famous short position against mortgage securities was established in 2006, not in September 2008. What these investors stopped doing was borrowing to extend their bets on an expanding economy. The leverage that had amplified their gains in the preceding expansion was the first thing they quietly dismantled when their assessment of the risk-reward calculation changed. The third behavior is one that sounds almost too simple to be significant. The wealthy stop making illiquid investments. Liquidity, the ability to convert an asset to cash quickly without significant loss of value, is something most investors treat as a secondary consideration during periods of economic expansion. When asset prices are rising, the fact that a particular investment cannot be sold quickly seems like a minor inconvenience. You are not planning to sell it quickly. You are planning to hold it while it appreciates. Illiquid assets, private equity, direct real estate, long-term fixed investments in operating businesses often generate premium returns precisely because other investors discount them for their illiquidity. Accepting illiquidity is how patient capital earns more than impatient capital. What changes in the period preceding a collapse is the calculation around what that illiquidity premium is actually compensating you for. In a stable environment, illiquidity means you cannot sell quickly if you choose to. In a collapsing environment, illiquidity means you cannot sell at any price when you need to. The difference between those two conditions is the difference between an inconvenience and a catastrophe. The documented pattern across pre-collapse periods consistently shows large, sophisticated investors reducing their allocation to illiquid asset classes in the 2 to 3 years preceding major dislocations. Before the 2008 crisis, the endowments and pension funds that came through with the least damage, notably several smaller university endowments that had resisted the full Yale model shift toward private equity and alternative assets, had maintained higher liquidity buffers than their peers. The institutions that suffered most catastrophically were those whose portfolios were most concentrated in assets that could not be sold when selling became necessary. Charles sold his downtown Philadelphia property in 1928, a property he had held for 12 years and had been publicly planning to hold for 12 more. He sold it not because he needed the cash immediately, but because he understood from 40 years of watching his father and then himself navigate business cycles, that the time to convert an illiquid asset to liquid form is before you need to, not after. Once everyone needs liquidity simultaneously, the market for illiquid assets ceases to function. The buyer who would have paid full value in 1928 does not exist in 1931. The fourth behavior, the wealthy stop, is publicly associating their identity with the prevailing economic optimism. This one is behavioral and social rather than strictly financial, but it is documented consistently enough across pre-collapse periods to merit examination. During economic expansions, the wealthy, particularly those whose wealth is recent or whose public profile is tied to their financial success, tend to become vocal advocates for the continuation of current conditions. They give interviews predicting further gains. They make large public commitments, philanthropic pledges, announced expansions, groundbreaking ceremonies for new buildings that signal confidence in the future and, not coincidentally, enhance their social and political standing. In the period preceding major collapses, a specific subset of the wealthy, those with the longest investment horizons and the least dependence on public perception for their business model, quietly stop making these public commitments. They do not become publicly pessimistic. Pessimism is socially costly and often self-fulfilling in ways that create legal and regulatory exposure. They simply become less publicly optimistic. The interviews become less frequent. The announced expansions are deferred pending further review. The groundbreaking ceremonies are postponed. Before the 1929 crash, several of the most prominent public advocates for the permanence of the bull market, including the economist Irving Fisher, whose declaration that stocks had reached a permanently high plateau became one of history's most cited examples of misplaced confidence, were not among the investors who had quietly reduced their equity exposure. The investors who had reduced their exposure were largely not giving interviews. Joseph Kennedy was not appearing in financial newspapers in the summer of 1929, explaining why stocks would continue to rise. He was converting his stock holdings to cash. The silence of sophisticated money is itself a signal. It is simply a signal that requires knowing what the noise sounds like during the periods when sophisticated money is not silent. The fifth behavior, the wealthy stop before a collapse, is the most counterintuitive, and it is the one that Margaret found most instructive in retrospect. They stop assuming that their existing relationships with financial institutions are adequate protection. Throughout periods of economic expansion, the wealthy maintain relationships with banks, brokers, insurers, and financial intermediaries that they have come to regard as reliable institutions whose solvency and operational continuity they have stopped actively questioning because nothing in recent experience has given them reason to question it. The relationship has worked. The bank has been there. The brokerage has executed the trades. The insurer has paid the claims. Familiarity substitutes for due diligence. In the period preceding major financial crises, the investors who emerge best begin quietly asking questions they had stopped asking. They review the balance sheet of their primary bank. They ask about deposit insurance limits and whether their holdings exceed them. They inquire about the custodial arrangements for their securities specifically, whether those securities are held in their name or pooled with other clients' assets in ways that could complicate recovery in an insolvency. They diversify their institutional relationships in ways that seem excessive relative to any specific visible risk, but that reflect a general reassessment of counterparty reliability. Charles's detailed questions to his New York banker in the summer of 1928 about the bank's exposure to stock market loans, about the procedures for accessing deposits in the event of a temporary suspension, were not based on specific intelligence about that bank's condition. They were based on a general reassessment of the reliability of the institutional infrastructure he had been taking for granted. He was not predicting his bank's failure. He was stopping the habit of assuming its permanence. In 2008, the investors who experienced the least disruption from the Lehman collapse and the subsequent institutional failures were not those who had predicted Lehman specifically. They were those who had, in the preceding years, stopped assuming that the institutional relationships they depended on were beyond question, who had reviewed their counterparty exposure, diversified their custodial arrangements, and reduced their dependence on the continued solvency of any single financial institution. They had stopped doing what most investors continue doing until the moment it becomes catastrophically relevant, extending unconditional institutional trust. Look at what these 5 behavioral changes share. Stopping credit extension, stopping leveraged long-term commitments, stopping illiquid investments, stopping public association with prevailing optimism, stopping unconditional institutional trust. Not one of them requires a prediction. Not one of them requires insider information. Not one of them is dramatic, visible, or easily distinguished from ordinary prudent financial management. The mechanism behind all 5 is the same. Sophisticated long-term wealth preservation is not primarily about finding the assets that will appreciate most in any given cycle. It is about identifying the conditions under which the assumptions embedded in current asset valuations might fail, and quietly removing the behaviors that would make that failure catastrophic rather than merely uncomfortable. The wealthy do not stop these behaviors because they know a collapse is coming. They stop them because they have learned, across enough cycles, that the cost of stopping them unnecessarily is low, and the cost of not stopping them when it matters is the kind of loss that takes a generation to recover from. Margaret retired in 1952, having worked for Charles's family for 35 years. She had watched 2 world wars, the Depression and the post-war boom, from the position of someone close enough to real wealth to observe how it actually behaved rather than how it was described in newspapers. What she took away from those years, what she told her niece when the niece asked her once about money, was not a formula, it was an observation. The people who came through the bad times with the most were not the ones who had predicted anything. They were the ones who had, quietly and without drama, stopped doing the things that only work when everything keeps going well. They had made themselves less dependent on the continuation of conditions they could not control, not because they were smarter, because they were paying attention to what they were doing rather than to what everyone around them was saying. This is historical and educational analysis. It is not financial or investment advice. The behavioral patterns documented here are drawn from historical records of specific pre-collapse periods and do not constitute a prediction about current or future economic conditions. What history offers is not a warning siren. It offers a set of observable behaviors that have, across multiple documented periods, preceded major economic dislocations, behaviors that are visible in hindsight and that were visible to those paying attention in advance. The pattern does not require a conspiracy to explain it. It requires only the recognition that the people with the most experience of economic cycles tend to respond to deteriorating conditions earlier and more quietly than everyone else. The pattern is already in the record. History Meets Economics exists to read it before it becomes necessary rather than after it becomes obvious. If that distinction matters to you, you know where the subscribe button is. Here is another moment. History Met Economics.